Namaskar and welcome all to the final session of KCA on Budget 2023. In today's session, we will visit amendments relating to TDS related provisions. And to take us through these amendments, we have with us CA Krishna Upadhya. Krishna Upadhya is a graduate in commerce from Bangalore University and is a fellow member of ICI. He is a rank holder in CA final, having secured All India 27th rank. His 10 plus years of experience post qualification began with a stint at ENY in International Taxation and Transfer Pricing Division. Currently, he is a partner in Upadhyay and Associates overseeing certain audits. His areas of work involve handling direct tax litigation to the clients, including appearing before CIT appeals and ITAT. He is also involved in advising various clients in transaction structuring, India entry strategy, cross-border tax structuring, transfer pricing, and repatriation strategy. He is also a co-founder of a fintech startup named Advait iTech, which is working on bringing out advanced automation in workflow management and work automation techniques in the field of tax and finance. He has he has keen interest in reading and researching about direct taxes. He has delivered multiple lectures at Bangalore branch of ICI, ICSI, and also at seminars organized by KSEA and BCAS. He has been a direct tax committee member at KSEA and BCAS for the last few years. Recently, he was also included in the Direct Taxes and Corporate Law Committee of Federation of Karnataka Chamber of Commerce and Industries. Apart from tax and technology, he has also keen interest in environment protection and music. With this very brief introduction, I welcome the speaker of the day and over to you, sir.
Thank you. Thank you so much for the introduction. Good evening to everybody. Thanks for joining in for this session along with me. Let me begin by sharing my screen. Just give me a moment. Yeah. So I hope my screen's visible.
Yes, it's visible, working.
Okay, perfect. So I'll switch off my camera for a while so that I have better connectivity when I talk, and then I'll come back on the video a little later. All right, so you would have been through the entire session on how the budgets have impacted over the last few sessions. It's a fantastic initiative by KSCA to make this as short duration webinars so that a focused attention can be given to a particular subject and a particular set of amendments that have happened. Luckily for us, the number of amendments that have been happening over the last 2 years, but Finance Act of 2022 and now the Finance Bill of 23, the number of amendments have reduced, but some of them are very far-reaching, so it becomes important for us to focus and get into them. So I'll be talking about the TDS-related provisions. This is one chapter, chapter 10 of the, chapter 17B of the Income Tax Act, which is undergoing changes ever since probably this chapter came into the law books. It is significant for the fact that this is one of the important modes in which tax collection happens to the government. And government has been innovating and have become very innovative in their approach and informative in their approach to sort of keep continuously broadening the way in which TDS and TCS can be brought into the income tax law, and thereby making sure that the tax collections happen on a regular basis. Therefore, the amendments which have been happening in this provisions and this chapter have been continuous. So getting into the first amendment that have happened, the amendment has taken place in section 192A. What is section 192A? Existing provisions are TDS is deductible under 192A on withdrawal of provident fund from a PF account to the extent that such accumulated balance is taxable under Rule 8 of Part A of 4th Schedule in the hands of the PF account holder. TDS is to be deducted by the trustees who run the PF scheme, if it is a Employee Provident Fund Act-based scheme under that or any other Provident Fund schemes. TDS has to be withheld by them, and the rate of tax is 10%, and the threshold above which the TDS is applicable under 192A is 50,000 rupees. There is also a proviso in this, the second proviso, which talks that if at all the person who's receiving the money on withdrawal does not furnish PAN to the payer, there is a TDS that has to be done at a maximum marginal rate of the MMR. Now, what the memorandum explains, Memorandum to Finance Bill 2023 explains is that because there are a lot of low paid employees who do not have PAN and they are generally not under the tax net, this provision of 192A and particularly this proviso 2 is causing a lot of hardship for them. Therefore, it is proposed that this proviso be deleted and the requirement to furnish a PAN, failing which MMR would apply, will not be applicable for 192A. And this amendment is expected to take place or come into effect from 1st April 2023. This is the first of the amendments that have happened in the TDS provision. Next is a very peculiar amendment and a very far-reaching one. So let me explain this. This is the amendment to Section 193. Section 193 talks about TDS to be deducted on interest on securities. And under this provision, TDS is to be deducted at rates in force on any interest that is paid out on securities to a resident by such a security issuer. And there is a list of items on which such provisions of 193 was not applicable. I have given an illustrative list here: interest on national savings certificate, interest on securities issued by central or state government, interest on debentures paid to individual HUF from a company in which public are substantially interested, then any interest payable on a 7-year NSE fourth issue, interest payable on defense loans scheme, etc. These were not covered under the provisions of 193. One other important limb on which 193 was not applicable was interest on dematerialized security, which are listed on the stock exchange in India. On these also, whatever interest were paid out, provisions of 193 would not apply. Therefore, TDS deduction was not applicable on this. And the TDS rate under 193 as of now is 10%. Now, what has been done is that out of the list of exemption, one of the exemption has been removed. And this is the removal is on interest on dematerialized security, which is listed in stock exchange. So that particular limb of the transaction on which rigors of 193, which was hitherto applicable, is proposed not to be applicable from 1st April 2023. That means on this particular interest that is paid out, TDS under 193 is required to be done. So what will this do? One, because there is no threshold under 193, there is no minimum amount on which TDS is not deductible, is not there. Any small amount of payout on, let's say, a listed debenture, listed bond, etc., TDS on the interest will become applicable and the company has to start withholding tax. There could be a lot of taxpayers who fall below the taxable limit. For them, this may become a headache because they'll have to then report and probably claim refunds in their tax returns. This is one of the things that it may happen. And this also is proposed to be effective from 1st April 2023. Now, another thing is that if you look at the memorandum explaining this amendment, it has been told that there was a lot of underreporting that is happening because this was not forming part of TDS. But I also understand that this was also already being reported under AIS. There was already a mechanism to report it. Now, why was there a requirement to withhold taxes on it at a rate of 10% without any threshold is not known to me. And also the fact that now this has been made applicable from 1st April 23 itself will become another challenge. Practically implementing this for companies could be a bit of a challenge, while I don't see it to be a major one, but then definitely it will be a challenge that will be there in implementation. Now, a set of amendments have been made in some of the provisions which I have listed at the top of the slide, which is 115BB, 194B, and 194BB. Let me start by talking about 115BB. Section 115BB spoke about taxation where the total income of an assessee includes an income by way of winning from lottery, crossword puzzle, horse race, or any other race, and gambling and betting and so on and so forth. And there was a fixed rate of tax on this at 30%, which was applicable. Now, 194B and 194BB had the TDS provisions related to these. 194B provided for TDS to be effected on winning from lottery, crossword puzzle, or card games, or any other game of sorts. And the rate of TDS was 30%. The threshold was 10,000 rupee. That is, any winning in excess of 10,000 rupee alone would suffer a TDS under 194B. Similarly, 194BB had the provision for reduction of tax at source on winnings from horse race or arranging for wagering or betting in horse race. The rate of tax and the threshold here was same as 194. Now, what has been done is that if you look at carefully, 115BB, which provided for taxation of such kind of incomes of crossword puzzle, lottery, races, etc., there were two other terms, gambling or betting of any form. That was there in 115BB, but was not there in 194B. That is, if there is a gambling or betting in any form, the provisions of 194B, which require TDS to be deducted, was not applicable. Now that has been brought into the ambit of 194B. Then in both 194B and 194BB, two other common amendments have been made. First of the amendment is that the threshold of 10,000 rupee is now replaced with the term amount or aggregate amount exceeding 10,000 rupee. The memorandum explaining this provision gives out what is the reason why this amendment has been made. It says that every game by a gaming provider or somebody who is conducting a crossword puzzle or a lottery or a horse race, every game was treated different and the threshold of 10,000 was applied per game. Now, what the legislature intend to do is that if the cumulative winning from such a game or betting or gambling is in excess of rupees 10,000 during a particular financial year, they wish to make sure that the provisions of 194B and 194BB in the case of horse race will be applicable. So this is the first common amendment that has happened. So like I mentioned earlier, in 194B, one of the amendment is that gambling or betting of any form is added. Second is the amendment in threshold, which has been done. The third that has been done is a common amendment between 194B and 194BB. They have removed online gaming from the ambit of 194B and 194BB. Any online gaming winnings are no more covered under 194B and 194BB. The reason is a separate transaction, a separate provision have been introduced into this, which I will be talking about now. So moving to the amendment on the online gaming, another provision 115BBJ has been proposed to be introduced. What is this expected to do? It is expected to cover income tax or the manner in which computation of income has to be done for winnings of online gaming. Now, a few interesting things. First, let me explain you what the provisions are and then talk to you about what are the interesting things that are there in this. Firstly, the provision says that income tax on such winning from online games will be taxed at 30% on net winnings. Firstly, important to underline the word net winnings. Second, whatever other incomes are there, they are taxed at normal provisions. And this provision is be effective from assessment year 24-25, which is from 1st April 2023 onwards. The taxation provision is coming into effect. That is 115BBJ is coming into effect from financial year 23-24, assessment year 24-25. Along with that, a TDS provision newly has been introduced, 194BA, which covers for TDS to be deducted in winnings from such online games. Firstly, this provision start with non-obstant, naturally meaning that no other provisions under this act for TDS will be applicable on this. And who is the person responsible for deducting the tax under this provision? It is the person who is responsible for paying the winnings. There could be some complications that may come out if you understand the structure of how an online gaming works. There could be a different player who will be offering the game. There could be a different provider who will be giving the online platform in which such games are being conducted. The person responsible for paying could be the online gaming platform provider and not the online gaming company which has provided such games. So there could be some bit of tricky situations that could come over here because the word usage of the word person responsible for paying. And what is, of course, the net income is on which the tax is required to be deducted. When they say net winnings, what does it mean? There could be some games in which a user could have lost money. There could be some games in which a user could have earned money on online games. The net of such winnings in a particular user account is to be considered for the purpose of withholding taxes under 194BA. How exactly the computation has to be made is yet to be prescribed. The enabling provision to prescribe the method is already there in 194BA. The other interesting thing is that the TDS is required to be deducted at the end of the financial year at rates in force. So it is not a monthly TDS deduction in like in case of various other TDS provision, or for that matter on every winning. It is only at the end of the financial year on which the TDS is required to be deducted. In case a particular user withdraws some money from his user account during the year, the provision also states that TDS has to be deducted on that part of the withdrawal immediately when the withdrawal is happening. And on the rest of the balance which is there in the user account itself, the TDS has to be deducted at the end of the financial year. There could also be situations where the winning may not be necessarily in the form of money. It could be in the form of some other kind of winnings could be there, and some cash portions could be there. Like in the case of other provisions on 194R and 194S, similar provision is also introduced or proposed to be introduced under 194BA, which makes it mandatory for the person responsible for deducting the tax to ensure that the person on whom such deduction is to be made already pays the tax on such net winnings. Only after that, you are allowed to allow the user to withdraw the money which is there in the account. Further, there are enabling provisions which are proposed under 194BA, which allows CBDT to issue guidelines if there are difficulties in giving effect to this provisions of this particular newly proposed to be introduced provision. Important to note that this TDS provision is coming to effect from 1st July 2023, while the taxation provisions under 115 BBJ is expected to come into effect from 1st April itself. So now there are quite a few terms which are used in the section 194BA and 115 BBJ. I have tried to tabulate them or enlist them here. Firstly, what is an online game? Online game has been defined to mean a game that is offered on the internet and is accessible by a user through a computer resource, including any telecommunication device. The word internet has also been defined, means the combination of computer facilities and electromagnetic transmission media and related equipments and software comprising the interconnected worldwide network of computer networks that transmit information based on a protocol for controlling such transmission. There are multiple terms that are used here, highly technical terms. Why the expanse of this definition is so high is because today games are being offered in multiple forms, multiple manners. There are games which are offered on blockchain-based protocol. Then ordinary protocols also games are being offered. To cover all such situations, the word internet has been defined extensively. Also, like I said, 194BA requires the TDS to be deducted in a user account. So those terms are defined in 194BA, which says that user account means account of user registered with an online gaming intermediary. And the word user means any person who accesses or avails any computer resource of an online gaming intermediary. Therefore, the word online gaming intermediary has also been defined, which means an intermediary that offers one or more online games. Like I said, if there is a intermediary, if there is a platform which is offering games, and the user has created an account on such platform, and the user account has some winnings, TDS has to be withheld on such user accounts. Now, whether the gaming provider or the online gaming intermediary, who's supposed to withhold taxes or deduct taxes? Like I said, the one who's responsible for paying is required to deduct taxes under this provision. What I said was interesting here is definition of the term. While they tried to define every possible word, in my mind, there is a confusion on one thing, which is what is a game? Now, one could call me stupid for having such a doubt, but I have my reasons why I feel that the word game must be defined. Uh, I don't see the definition of the word game in any other provisions in the Income Tax Act. Why it becomes important is because what is a game? Let's say if, an IPL series is going on, there are predict and win contests that goes on. Now, is that a game? Because you may predict who's going to win who's going to win a particular game, and then you all can send a message or go on an app and say predict who's going to win that particular game, who's going to hit the most number of sixes. I'm not talking about these gaming platforms which are specifically designed to play such games, like the Rummy Circle and all of these. I'm not even talking about them. I'm talking about the IPL organizers, the TV shows, or the broadcasters trying to create an excitement and a user interaction whereby they make the users predict and win some goodies, win some gifts, win a opportunity to meet a player, and these kind of things. So the question is, are these online games? And when these are being carried out by a broadcaster, television broadcaster, who may also have a broadcasting facility through the internet. Now, is this an online game in itself? Are questions that may come up in future, are required to be answered in future. So this I thought is a very interesting element or a dimension to these provisions under 115 BBJ and 194 BA. Moving further, section 194N, as most of you may be aware, is TDS provisions on withdrawal of cash beyond certain limits. Banking company, cooperative societies engaged in the business of banking or post offices are responsible for deducting taxes on amounts withdrawn in excess of 1 crore rupee from a person from one or more accounts during the particular financial year. And the TDS rate is 2%. At the time of such payment, it has to be deducted. Now, there are two particular exceptions or carve-outs. One carve-out is if the recipient has not filed the income tax return for 3 assessment years prior to the year in which the withdrawal is being made, the threshold and the tax rate changes. The threshold drops down to 20 lakh rupee, and the withdrawal between 20 lakh and 1 crore rupee attracts a TDS of 2%. Beyond 1 crore attracts a TDS of 5%. And for certain payments made to government, bank, another banking company, another cooperative society engaged in business of banking or post office or Reserve Bank of India and ATM operators, etc., 194N is not applicable. This is the existing provision. What is the proposed amendment? The proposed amendment is where the amounts are being withdrawn by a cooperative society, the threshold is increased from 1 crore to 3 crore. Point to note, cooperative society engaged in banking business is already excluded, so they don't come under this. Who comes under this is cooperative societies who are not under banking business. Other cooperative societies, they fall under the enhanced threshold of 3 crore rupee. And this also is, I don't see any effective date that is brought in here. So I think the general effective date of this 1st April 23 should be applicable for 194N also. Moving to 194R, little context and background what 194R is. I'm sure most of you would already know this. When a person responsible for paying a benefit or a perquisite which arises on the course of business or profession is required to deduct tax on the recipient of such benefit or perquisite, whether such benefit or perquisite is convertible into money or not. TDS rate is 10%. The threshold was 20,000 in a particular financial year. Now, what is the amendment? The amendment, there are amendments which are made under section 28(4), which has the charging section for this particular provision, as well as in 194R. The amendment is that when the benefit is in cash, kind, partly cash or kind, or in another manner which is whether convertible into money or not, all the situations have been covered. The memorandum explaining 194R says that there were confusions or questions that got created when the benefit or perquisite were paid by way of money, whether this is applicable or not. Circular 12 and Circular 18 of 2022 gave out a lot of FAQs on this, including FAQs on whether waiver of loan, does it get covered under 194R, and so on and so forth. What I understand from reading the memorandum, the circulars, and the proposed amendment is that probably there was some room to think that there is an element of interpretation which is happening, that the benefit or perquisite. This also originates from the Supreme Court judgment in Mahindra and Mahindra, where it was said that the word used as benefit or perquisite, and this doesn't really include cash benefits or perquisites. But then the circular 18 and 12 sought to say that even those are covered, but that was extending what is already present in the law itself. Therefore, I think this amendment has been brought in to make sure that whatever benefit or perquisite is given out is also probably covered under 194R. This can result into multiple scenarios in a practical situation. Since this is a short series, I am not dwelling into too much of detail. Maybe that is for another day for discussion. Few more amendments that have happened. One small amendment in section 197, which allows applications to be made for lower deduction of tax. The section 194 LBA, which was hitherto not covered, has also been brought in now, where TDS on distributed income from business trust to its unit holders, they can also apply for lower deduction under 197. 206 AB and 206 CCA, which provided that enhanced TDS for non-filing of ITR or enhanced TCS for non-filing of ITR in certain cases, there was an exception in the proviso, which said that these provisions will not apply to non-resident who does not have a permanent establishment in India. For them, the enhanced TDS, which was there in 206 AB, or enhanced TCS, which is there in 206 CCA for non-filing the return, was not applicable. Now, one more category of people for whom the provisions are not applicable have been brought in, which is to say such person who is not required to file ITR for a previous year as notified by central government. They've kept it open for a notification to be done in future. I think why this has been brought in is there could be certain government organizations, departments for whom filing of ITR is not applicable because of their income being exempt under section 10, and there is a specific exclusion from filing ITR, and they may be having certain incomes on which TDS is required to be deducted, because of which 206 AB or CCA might become applicable. Therefore, to avoid such a circumstance, maybe the central government wants to notify certain organizations or certain personnel for whom the enhanced provision may not be applicable. This is another very draconian, I would want to call it, if I may, amendment that has happened, which is TCS, provision on under 206 C1G, which provided for tax collection by an authorized dealer in situations of remittance to be made outside India under the liberalized remittance scheme, or for overseas tour package. Now, what was the current provision? The current provision was that in cases of liberalized remittance scheme remittances, not the ones on which TDS is required to be done under 195. Other than that, whatever were there, on that, TCS was also to be collected by the authorized dealer who was helping make such remittances. Now, what has happened in this provision is that few things have remained unchanged. That is, there is a proviso in 206C1G, which talks about, TCS to be made if the amount being remitted is out of a loan for education purpose, which is a loan defined under section 80E. On that, there is a lower withholding, a lower tax collection of 0.5% when the aggregate amount exceeds rupees 7 lakh. On that, there is no change. It stays as it is. For any other education purpose other than the one which I already explained now with a loan defined under 80E, the limit is 5% and the aggregate amount exceeding 7 lakh is the threshold on which, beyond which TCS is required to be collected. On this also, there is no change. What is the change that have happened? Overseas tour package also enjoyed 5% without thresholds till now. Now the rate of this has been increased substantially, which is 20% without any threshold. Any other case of remittance of liberalized remittance scheme, what could those be? For example, there is a gift that is being made by a relative from India to outside India. Within the, let's say, parents are gifting some money to their children outside India, would get covered under the liberalized remittance scheme, on which tax is may not be required to be deducted. On that, now probably TCS collection at 20% is going to come in, and that too without any threshold. This is going to be, in my view, a substantial change. And there are also situations where, let's say I as an individual have an account in India, I have an account outside India, and I am transferring monies from here to there, or I'm buying a property outside India by moving money from my Indian account to making a payment to a person outside India. Now, all of these situations will get covered under this TCS provision. 20% of that money will get locked up in TCS. While one can say that eventually you can claim that as a tax credit while filing your ITR, but imagine the quantum of impact on it. 20% of that money will get locked up in TCS. Couple of last amendments. Amendment made under 155(20) by introduction of a new provision, a proposed introduction rather, and proposed changes to 244A, interest on refunds. What is this? There used to be a situation where, based on accrual of income, I as a receiver of money might have to offer certain incomes to tax in a particular financial year. The deductor might be deducting taxes in a subsequent year, and the TDS credit might be provided in the subsequent year. Now, what would happen is that the TDS credit would be falling in a subsequent year, income were to be offered in tax in the prior year. There was a mismatch. And the provisions of 199 says that TDS credit is to be offered, is to be considered in the year in which the income is offered to tax. Now, because of this mismatch, and more so because in 26 years there is a challenge. In the year of offering the income, there is no TDS, and in the subsequent year, when the TDS is there, you're not offering that income to tax. There was a mismatch. There were judgments which have said that TDS credit have to be preponed and allowed in the year in which the income was already offered to tax. In order to give a certain procedure to that particular situation, this amendment has been made where an SSE can make an application within 2 years from the end of the financial year in which such TDS was deducted, and make sure that the TDS credit is moved back to a year in which such income was already offered to tax, and refund that gets determined because of this TDS credit, the interest on that refund has to be calculated at 1.5% per month from the date of making that application till the date of granting such a refund. That proposed amendment is expected to take effect from 1st October 2023. Last of what I wanted to cover today is amendment in 241A and 245. What is 241A? 241A provided certain powers to assessing officer to deny refund or withhold the refunds which gets determined while generating intimations under 143.1. If for the same assessment year there is a notice under 143.2, selection of scrutiny has been issued. And this power had to be exercised by such AO after taking suitable approvals. On the other hand, as you all may be aware, Section 245 provided for adjustment of refund with a demand which is outstanding against a particular SSE. Now, what has been done? With effect from 1st April 2023, 241A has been made inapplicable and the entire 241A provision have been brought in 245 itself. The entire Section 245 has been replaced with two subsections now. Subsection 1 continues to be what used to be there earlier, which gives the power to a AO to adjust refunds and demands against the same assessment, against the same SSE, if at all it is there, after, of course, serving a notice and calling for explanation from such a SSE. Now, 245 also gives power to the AO now to withhold refunds, not only for the purpose of demands which are outstanding, but also where the AO believes that providing such refunds would be prejudicial to the interest or adversely affect the revenue. In such a situation, after seeking suitable approval from CIT or PCIT, they can withhold those refunds, provided in such particular assessment year, notice under 143.2 has been given. So basically, the sections 241A and 245 have been combined into one particular provision. So these are some of the things that I wanted to cover today. The ladder on the left-hand side of the screen says that there is a lot more in TDS that we'll have to learn every single day, and it's just the beginning. And how once the provisions are understood in detail and its practical implications may happen is to be understood and seen in future. I just made a small attempt to give you a snapshot of the proposed amendments which are there right now. This is what I wanted to cover. Maybe if I have some time, I will probably be taking a few questions. Do I have some time to take questions?
Yes, yes, sure. There are a couple of questions in the Q&A box. You want me to read it out for them, for you?
No, I can see it. So there was a question which says TDS provision for tour packages is now increased to 20%. However, is this applicable even if services are separately provided for air tickets, package separately? I think this confusion existed even now. It's not a new one. The word used is purchase. Let me read out the exact word. It says being a seller of an overseas tour program package. Now, I don't think so. There is a definition of the term tour program package that is there in the law. Or rather, it is there. It says means any tour package which offers visit to a country outside India and includes expenses for travel or hotel stay or boarding or lodging or any other expenditure of similar nature or in relation thereto. In my mind, only when it's a package, this definition has to be very literally interpreted. It cannot be interpreted in loose terms. Only when it is a combined package is when probably the provisions will apply. However, if it is also to be noted very carefully that if an artificial splitting of air ticket and the rest of the cost is done by a tour operator just to circumvent 2061G, that may not be a great advice to give. And therefore, one has to see whether the contract for sale of air ticket and the contract of sale of helping booking a hotel, etc., are they actually separate contracts? Only then probably you can say that they are not packages. If they are, if there are circumstances or facts states that they are combined sort of a thing, just been artificially split, I would think it is not wise to go under that. There's another question. Online game is a game that is offered over internet. If there is a game which is not over internet, say there is predict and win contest that operates over SMS, or say there are games which work over private networks which are not on World Wide Web, can it be argued that these games are outside the ambit of new tax provision? So let's read the definition. For this, what becomes important is to read the definition of the term internet. So they have defined the word internet extremely broadly. They say combination of computer facilities and electromagnetic transmission media. Now the challenge is how on the SMSs these are being transmitted. We aren't sure. And related equipments and software comprising the interconnected worldwide network of computer networks that transmits information based on a protocol for controlling such transformation. So what can happen? At a user side who's predicting and winning over SMS, the interface could be through telecommunication devices, which is through your mobile SMS. But the transmission may still be happening using World Wide Web, because there are bulk SMS services today which operates on the internet, which uses the internet protocol and connects to the telecommunication protocols and then sends out the SMS. In such situation, can you still argue it is not being provided on internet? Is a question to be answered. Private networks. So now I don't really get what is private network and how that will operate. So probably I'll not be able to answer that. But then again, one has to very carefully see whether it fits within the definition of internet or interconnectivity that is being brought out in the definition of the word internet. There is no justification reasoning given in the memo for reducing the threshold and increasing the rate of TCS on overseas tour package and any other case. What according to you might be the real reason behind? Okay, so one reason that I can think of is that there have been situations where government has been getting data about people traveling overseas and their income tax return either showing just above the thresholds of taxation or below basic exemption limit sort of a situation. So those are the situation which I think is trying to be captured over here to say that at least if TCS is deducted, there is a possibility that they will start offering that to tax, or it comes under the tax ambit. That is probably one of the reasons why they are doing that. There's another question. Any other purpose of TDS and foreign remittance and includes to dependent? Please elaborate with example. I slightly didn't understand the question here. Any other purpose of TDS and foreign remittance? See, any remittances covered under liberalized remittance scheme under FEMA is sought to be covered over here, which could include, making monies available to dependents, and all of them. So all these situations are covered now, unfortunately, under 206C 1G, and I don't see any other exception which is there given over here, and it is directly linked to liberalized remittance scheme.
I think that's all we have towards the open questions for today's session. I take this opportunity to extend a formal vote of thanks to our speaker, CA Krishna Upadhya, on behalf of KSCA and all attendees. Sir, we thank you very much for your insightful and delightful discussion on proposed amendments pertaining to TDS related provisions. Thank you for having consented for our program and having devoted your time.
Thank you. It was my pleasure to be a part of this program.
We also thank all the attendees for their participation. Thank you all. The session stands concluded. Thank you.
Thank you so much.